The cost of capital reflects the average cost of the financial resources used by a company to finance its assets. It includes the costs associated with the different sources of financing, notably equity and debt. We refer to the weighted average cost of capital, WACC, and often use the English acronym WACC for weighted average cost of capital. This weighted average is calculated as follows. It is the proportion of equity multiplied by the cost of equity plus the proportion of debt multiplied by the cost of debt after tax. This formula takes into account the tax advantage related to the deductibility of interest on debt, which reduces the effective borrowing cost for the company. Let's look at a numerical example. What would be the WACC of a company financed with 6,000 euros in equity and 4,000 euros in debt? The cost of equity is 10% and the cost of debt is 4%. The tax rate is set at 30%. The cost of capital will therefore be equal to 60%, the weight of equity times 10%, the cost of equity plus 40%, the weight of debt multiplied by 4%, the cost of debt times 1 minus 30% to account for the tax impact. Given its capital structure, this company finances itself at an average cost of 7.12%. The cost of equity is the most complex component to assess, especially for unlisted companies due to the limited amount of available information. It is calculated using the Capital Asset Pricing Model, or CAPM. The cost of capital is a fundamental concept in finance that represents the minimum rate of return a company must generate to meet the expectations of its investors, whether they are shareholders or creditors. It serves as a benchmark for evaluating the profitability of investment projects, and it is essential in strategic financial decision-making.